There it is. All right. So we have a really exciting panel, the Acquiror's Vision, and really treat this morning to have these gentlemen up here. I'm going to let each of them introduce themselves and their company. Then we're going to cover some regulatory background. Then we're going to cover some kind of operational things with Josh at the end. And then it's going to kind of be a free-for-all on risk questions. And so we kind of really want to cover a lot of ground, so we'll get going. Sam, why don't you go and introduce yourself and then your firm, and then toss it to Mike.
So my name is Sam Ramos. I'm the Chief Legal Officer for Global Atlantic Financial Group. And I've actually been with the company since its inception in 2004.
Good morning. Mike Considine. I'm head of Global Regulatory and Government Affairs for Athene. Prior to that, I was CEO of the National Association of Insurance Commissioners and one time Pennsylvania Insurance Commissioner. Got to work with Mr. Gerhardt in a number of different capacities. Great to be here today, first time on the Drake campus. My wife is a Drake Law graduate, and I'm under strict instructions to go to the Drake Diner after this and bring her home some cinnamon rolls. So if you guys can help me with that hookup, I'd appreciate it. So.
Awesome. Hey, Josh Face here. Good to meet you all. Great to be here. Thanks for having us. I am the Chief Operating Officer of American Equity as well as American National. Both of them are owned by Brookfield Wealth Solutions. Good to be here.
Great. So we're going to start with some regulatory questions because I think we have two of the foremost experts in this thing right here, so we're very lucky. Sam, so you have a very long, diverse background covering legal compliance, regulatory affairs. Around 2012, 2013, kind of private equity-backed insurance carriers caught a lot of attention, obviously, at NEIC and with regulators. I'd really be good if you could outline to the audience, kind of the move that some PE firms made into the space, some of the regulatory issues that were around back then, and kind of just a historical view of what had happened. And we're going to turn it to Mike after that to get some current views.
Sure. So first of all, Nick, thanks for inviting me to the panel. I know that you were a commissioner when we first came into Iowa, and appreciate.
I might have been right at the tip of the spear.
Yes. We appreciate the relationship that we had with you. One of the things about PE coming into the insurance industry, you hear about that a lot, and it almost seems like this is a PE coming in to just buy an insurance company. I think what people need to realize is that this is a real partnership. This is a partnership between PE, alternative asset managers, and insurance companies. And it's a partnership that benefits both parties. It's not like one day PE companies woke up and said, we just want to buy insurance companies. Without the benefits that the insurance company gets from the relationship, these transactions would not happen. And you can't divorce what's happening in the industry, the evolution of the industry, without thinking about what's happening demographically in the United States and probably the world, right? Which is, in the United States, 11,000 people are turning 11,000 Americans are turning age 65 every day. Nick and I were talking about yesterday, there's even more people turning 35 every day than turning 65. So what does that mean? For 65-year-olds, they're going to be retiring soon, so there's a retirement challenge. For 35-year-olds, they have to save for retirement. You see a decline in defined benefit plans. Now you see defined contribution plans. What does that mean? That means that people have to decide how to make their money last at a time when they retire, and they're going to live longer than anyone else has ever lived before, except for biblical times. In retirement. And so there's a real retirement challenge out there. And, speaking for Global Atlantic, when we looked at that, we saw a huge opportunity to be able to address that challenge. But there were two things that we really needed in order to do that. One was capital. The other one was asset origination expertise. This is a very capital-intensive business. And when you get premiums, you got to invest those premiums in a way that you're going to be able to meet your policyholder obligations. You have to pay your capital providers, you have to pay your employees, and you have to pay your most important partner, which is the federal government, and your most demanding partner. And so when we thought about that, and when a lot of insurance companies think about that, they basically say, okay, we could go into the public markets, but that really solves the capital problem, not the investment problem, not the asset origination problem. And for Global Atlantic, when we met the KKR folks, we said, this is going to be a great partnership for us, because number one, they were going to be able to contribute capital to us, and number two, they had a global asset origination platform that could really get us the assets that we needed to generate the right returns. So I think it is important for people to realize that this is a partnership. From a regulatory perspective, we're completely empathetic to what the regulators are going through. Industry is evolving really quickly. Regulators are trying to catch up. They've got the 13 considerations for, they said it wasn't just PE focus, but it is in many respects PE focus. They're looking at the capital that companies are holding for their assets. We think that's a good thing. We were not supportive of what they did with respect to residual securities, increasing capital charges on that, only because we didn't think that recognized, number one, truly recognized the risk in those securities, and number two, wasn't broad enough to capture other securities that could have been riskier and needed more capital. So they're looking at that. And from a regulatory perspective, they're also looking at reinsurance, which I think we can talk about a little later, and in particular, reinsurance offshore. So you are seeing the regulators now, I think, appropriately focused on what's happening in the industry, coming out with regulations. We support a strong industry, a stable industry. We just want to make sure that the regulations are such that they address the risk, but don't unduly impact in a negative way our business.
Thanks, Sam. So, Mike, I guess some of your thoughts on the current environment. I know with your background as NAIC CEO, you were at a lot of the meetings, and now where you're on this side, you're kind of have a even more different view, I would say. So, what are your thoughts on where we're at regulatory wise, and any other comments you might have had on Sam's points?
Thanks, Nick, and again, thanks for being here and the invitation. I'll start with maybe just some observations, picking up on Sam's comment. And I think one of the things I would offer, particularly to the students in the audience, is what an exciting time to be going into this sector. I've been in various regulatory roles for the past 20 plus years, and what I'm seeing happen and what I saw was happening when I was at the NAIC and even before there as a commissioner in the life sector is truly a transformative period. Sort of this marriage of insurers and asset management is really led to kind of a catalyst within the sector, and the reasons for that, why that marriage made a lot of sense, and you've heard Sam talk about it, is just combining, picking up on sort of the economic tailwinds that started to exist after the last financial crisis, particularly as banks stepped away from financing the real economy. There was an opportunity for companies like Apollo and KKR to step in and essentially provide private credit solutions and to a large part of the economy that still needed that. And when we talk about private credit, and you'll hear that a lot, it's simply sort of financing that takes place out of kind of a traditional banking context. It is an enormously huge market, and I think that's one of the things that the regulatory community has started to really appreciate, is how much the economy has changed since the financial crisis. I mean, there was a time when everybody thought in terms of public markets and public bonds and corporate bonds, and thought of our economy as really driven by the traditional, sort of public entities and traditional banks. That has changed, and as a result of that change, there was an opportunity for us to step in with a model that really maximized and I think delivered to the economy in a couple really significant ways. On the asset management side, we're still providing, again, financing solutions, private credit solutions to what we calculate as a $40 trillion marketplace in terms of what private credit constitutes in this country. And what that generates is sort of long-term assets, which naturally get married up very nicely with long-term liabilities within a life insurance company, and allows us to then provide very attractive products, life products, retirement products for American consumers. And as Sam noted, we're in the midst of a retirement crisis here. So that is addressing a really significant need in the U.S. right now. But I think what it signals to regulators, particularly insurance regulators, is, again, this huge shift and increasing responsibility that, frankly, they have over the real economy that they did not have, 10 years ago. So as banks sort of step back a little bit in terms of what they're financing, you're seeing it being picked up by insurance companies, asset managers. So the insurance regulators, as Sam noted, I think are trying to react to what is a very different environment than they've been used to. I mean, there was a period of time, and Nick and I as regulators, Susan Voss is here, former Iowa regulator as well. I mean, the life sector was usually the pretty sleepy, boring sector. All of the action was in P&C and health for forever, but that has changed, and I think they're reacting to that. I know, again, I can see that and feel that. And I think what we're trying to impress upon them is the need to take a very balanced, thoughtful perspective. Sometimes the tendency of a regulator when they see transformational change happening is to react very prescriptively and go, basically, let's stop it all until we can understand it. Thankfully, we don't see that happening in the U.S. The NAIC, NAIC, for those who don't know, is just basically it's a standard-setting agency that supports state insurance regulators across the country. It is not a regulator, but it has sort of quasi-regulatory functions in terms of producing model laws, model regulations that are ultimately adopted by the states. So they're going through that process right now of evaluating the marketplace and trying to figure out, how to react to it, because things are changing. And as Sam has said, we don't suggest that no changes in regulation are needed. In fact, they probably are, again, because it's a much different investment environment. It's a much different capital environment that it has ever been before. But we have a real opportunity here in the U.S. to continue to preserve both the opportunities that are presented by business models like ours, but also address the regulatory concerns that regulators have. And those go to how much, alternative investments should a insurance company have on its books. I mean, between sort of, public securities and corporate bonds and sovereigns and then alternative assets, what's the right amount? And within those alternative assets, again, non-public assets, how much, should you have at different levels? For Apollo, we were mostly invested in, sort of investment grade, AAA to AA alternative investments. So very highly rated, very secure. But there are some companies that have different mixes. So, and then of course there's, as Sam mentioned, there's an issue of reinsurance. How much business should companies reinsure, and how much business should they reinsure to offshore jurisdictions? So we may have an opportunity to talk a little bit more about that, but it is an interesting time, as I said, to be in the seats that we're in. It's an interesting time to be in the seats that you all are in, and I don't envy the regulators, but it's exciting for them too.
So we do have a number of students I know virtually, but we were talking last night at dinner, and just the Des Moines market has become much more interesting, I think, for younger professionals, with firms like you all, having strong presences here and potential career growth. So the opportunities for younger people, I think, and students in particular, is really interesting. You touched on alternative assets, so I'm going to pick on it a little bit, Mike. I'll start with you and then go to Sam. So, CLOs, I know these have gotten a little bit more scrutiny, I would say, right, with regulators. So talk a little bit more to why that is an issue with regulators and maybe how you are addressing those issues.
So again, when we're talking about alternative assets, again, we're talking about investments in sort of the private credit ecosystem outside of publicly traded securities, corporate bonds. And that in of itself represents a little bit of a sea change for insurance regulators. I mean, they're very accustomed to their insurance companies taking historically very conservative, very safe investment decisions. And that's not to say what we're doing is unsafe. As I said, it's an investment grade security or investment. There are a lot of rating agencies who are involved in looking at these things, but still, just the fact that there is an increase in the level of investments into non-public securities is something that regulators are looking at. I think they're also, concerned about a couple of things. One is liquidity. So with a public security or corporate bond, there is liquidity in that. If an insurance company needs to get the benefit of that investment, it can sell the bond, sell the security on the public market. What regulators are somewhat concerned about is a lot of the alternative investments are illiquid, intentionally, and that's, we get a benefit from investing in, it's called a liquidity premium. You actually get more from investing in something that you can't immediately trade. And for us, that's not a big deal because, again, we are matching those long-term investments up against long-term policy liabilities. So we don't have an incentive to sell quickly. But nonetheless, especially from regulators who do both banking and insurance, they're used to their regulated entities having enough liquidity. And what we say was, beyond those investments, we have lots of capital and surplus that we can get into. Aside from that, there's also a question around sort of the transparency of these investments. You can go online and learn a lot about sort of any kind of publicly traded security or bond. That information is out there on these alternative investments. It's just in different places and harder to find, than potentially some of the public stuff. But it's out there, but I think that is a fair point and one that we're looking at as an industry. And then I think finally, as I mentioned, and we'll probably return to this, there's a component to it where we have reinsurance arrangements. And in Athene's case, we have a reinsurer in Bermuda, as do a lot of companies. Bermuda is a very well-recognized, very well-regulated jurisdiction. But there is a lot of business that is being reinsured into Bermuda. And the question is, from regulators, fair enough, is why? Why are you in Bermuda? Why is so much business being done out of Bermuda? And our response is, and Sam alluded to this, is Bermuda is a jurisdiction that its rules allow for very effective generation of capital, which in turn is utilized to, generate more business here in the U.S., cover more policyholders. And I won't go down the rabbit hole of the U.S. tax laws and the investment laws that make Bermuda, but it's not for purposes of getting like a tax advantage. For us personally here in the U.S., we pay full U.S. taxes. It's really not even for purposes of what's called regulatory arbitrage, which is getting kind of a capital or surplus advantage from doing. It's really for us. It's about raising capital. Nonetheless, regulators are looking at that because they're seeing that business, and it's like, well, what's our level of oversight and ability to kind of access that business if there is a need to do so? And good answers to all of that. I think there's over the last year, we've had a lot of discussions with regulators, demystifying sort of what is, some of their concerns. But again, you've got really good players represented here today, but there are a lot of companies who are seeing the business models that we helped create, and then replicating it in ways that maybe cut some corners. And we all have concerns, and this is concern whether you're private equity affiliated or not, that some company is going to go sideways. And I think Nick will talk about this.
We might have a question.
And then there's reputational harm to all of us. So we get the concern.
Yeah, I think just to add a little bit, I'm not going to add anything to the CLO and the investments because I think you covered that really well. I would just go back to first principles. You got hundreds of billions of dollars of assets. What is the most efficient and effective way to invest that portfolio? We have a responsibility to our policyholders and the people that provide us with capital to invest that money, that portfolio, in a way that's going to generate the right risk-adjusted levels of return. And if you went to a financial advisor and you said, I'm going to retire in 15 years, help me invest, and the advisor said, well, just buy corporates and treasuries, you'd probably fire that advisor because no one can agree that that is the right strategy for an individual. It's not the right strategy for an insurance company. We need a broad-based portfolio that as Mike said, matches our liabilities and reduces risk because of its diversity and because we're getting higher yields based on illiquidity and complexity factors, and not because we're increasing the risk. So I would just think about that when you think about the investments that companies are making. It is really the way that we should be investing our money.
That's a great point. So Mike alluded to this next question. So 777 Re's made some news, obviously, in our industry. How do you look at that as a one-off, and then the potential scrutiny that might bring to other firms? And then if that scrutiny comes, how do you distinguish your firm? I guess, Sam, I'll start with you.
Yeah, one of the things I think about 777, it's an insurance company, made some bad investments in some European football teams, had reinsurance company in Bermuda. I don't see 777 as a failure of regulation. I see 777 as a failure of regulatory oversight. I believe that the regulators had the rules in place, had the authority in place to be able to provide the correct level of oversight, to look at that investment and prevent that investment from happening. I think now regulators, because of that, regulators are asking for a lot more information. I think Mike alluded to that. We're providing them a lot more information. They're sending us a lot more questionnaires. Bermuda has gotten Bermuda passed a new regulation that now every single affiliate investment has to be approved by the Bermuda regulator. By the way, the U.S. has had that forever. We get all of our affiliated reinsurance transactions, for instance, approved by our regulator in the U.S. And so, do I think 777 was a bad thing, bad for the industry? Those are the kinds of things that Mike was talking about when he said, there are some people out there that are using the business model in an incorrect way, and we think that there should be regulations and oversight to stop that, because that's not good for anyone.
Yeah, I think Sam gave a great answer, and I would say single failure does not and should not define a marketplace or a regulator, and insurance companies fail. It happens well, not all the time, thankfully, but I mean it happens, and it happens for a variety of reasons. Some of them just have a natural business cycle life. Some of them make really poor business decisions, and some cases there's just outright fraud. And there are failures that can occur on a size and magnitude that impact the entire industry. And there were a series of large liquidations back in the 2000s and before that really caught the attention of Congress and others, and led to a lot of focus on the insurance sector and state insurance regulators, which led to in turn a lot of change. And we don't want to have a failure of significant size and magnitude, and even a series of small failures is bad if they're happening for the wrong reasons. But as Sam said, in this case, you had a failure of a company that I agree was not really a failure of the regulation per se. It was kind of more a lack of oversight. That's been corrected. But still, I think we all worry, and you ask any CEO of any life or P&C company, what's in their top 5, things that they stay awake about, and it is the risk of contagion, reputational harm. That if a large company or mid-sized company goes down, the regulation will react to what is perceived to be the weakest link in ways that can often harm entire business models for even companies that are operating totally above board. So that is something that is, Sam said, we support appropriate regulatory change, so the chances of that get minimized.
Great. So Josh, we're going to have a few questions for you, and then kind of the free-for-all and the risk here. So Josh has a pretty unique background, even probably before your Brookfield time, I would say, right? So, and Brookfield's an interesting company, how it's set up, has some P&C investments, I believe, as well, right? So I guess, maybe just your general investment hat on, why is it that these firms find life insurance carriers so interesting from an investment thesis? We'll start there.
Yeah, absolutely. I think if you take a step back, just to simplify it, on the life and annuity side, it's really a spread business, right? So a policyholder gives us their money, we go ahead and invest it, and if you can create better value on those investments, invest it at higher rates while not taking undue risk, you're then able to provide more value to the policyholder. And so naturally, people and institutions that are really good at investing capital are going to be strong at this business. You know, Brookfield's been around for 120 years, mostly focused on real assets. So think about, you know, infrastructure, real estate, renewables, and really spent, you know, those 120 years honing those investment skills, and now able to bring it to bear in this industry.
So, and do you think that thesis is panned out and going to continue to grow in the future as in the United States, or what's your view like kind of going forward?
Yeah, I think so. So I'd say, you know, within life and annuity, I do think you're going to continue to see more interest from, you know, alternative investment managers. PNC is a little bit different. PNC, in addition to spread earnings, the other, call it, you know, half or 20, 30% of your earnings is underwriting earnings. And so for that piece, you really want some operational strength. And so the reason we got into PNC in addition to life and annuities is, you know, of the 120 years Brookfield's been around, 100 of those has been really in an operational role and really managing its own money. So basically like a Berkshire Hathaway type family office. And it's really just in the last 20 years that Brookfield's taken outside capital in. And so, you know, what I'd say again, just to summarize, life and annuity makes a lot of sense for alternative asset managers. You see that to continue to grow. PNC is going to be a little different, but it's an industry that we really like.
I want to spend a little bit of time on product. So when you think about product, you talked about the spread business, the value to consumers. Do you think having this ownership structure with your investment expertise adds additional value on the product? Because at the end of the day, you know, consumers are buying these products for retirement and accumulation. So do you think that gives you a competitive advantage in the marketplace?
Yeah, totally. I would just say two things. So the first is, you know, quite simply on that spread approach, the better you can do on the investments, the more value you can give away to the policyholder. So that's one. Number two is if you're coming into the space with a fresh set of eyes, and able to just look at everything on a first principles basis and just say, does this make sense? Why not? You're able to bring new ideas and do things a little bit differently. Now, where that goes wrong is if you think you're a know-it-all and not a learn-it-all. One of our CEOs, mentor of mine, that's his favorite go-to. You want to create a culture of being learn-it-all. So where special things happen, I think, is you get people coming in with new ideas, first principles approach, curious, wanting to understand and ask questions. And then you want people in there with, you know, decades of experience in operating these businesses to be able to have that counterbalance to say, great idea, we did try that, here's why it won't work, or good idea, let's go ahead and try to execute on that.
Great. So last question before we go to the risk side of this. So how do you all view decumulation versus accumulation? Is decumulation a threat or an opportunity in your mind, Josh?
Very interesting dynamic, and I think it's going to be an opportunity. So here's simply how we think about what that is and why that's going to be helpful. So quite simply, when you're, call it, you know, younger to let's say 55, you're in the accumulation phase of your life. So you're buying policies so that it grows in value. Once you hit, let's say 65, 70, you're buying policies that give you income for life. So you give your money to an insurance company, and they give you a paycheck every year until you pass away. And so what's happening now is the population that's hitting 55 or 50 is not as large as the population that's going to 65, 70. That's huge growth in that population, as you know. And so what's happening is you're seeing more and more policies being sold in decumulation, i.e. income, as opposed to accumulation. And I think there's two things that an insurance company needs to do to be really good at decumulation. One is you need to be able to generate long duration assets. So accumulation, these are 3, 5, sometimes 7-year policies. Decumulation, these are 10, 15, 20-year duration policies. So it's not too difficult, I'd say, to generate assets for 5, 6, 7 years. But these high yielding 15, 20-year assets are really, really difficult to generate. So one, if you're able to do that, to match it up with your decumulation policies, that's going to be an advantage. Two is ratings is going to be really critical. So a lot of entrants in the space, and not everyone is A or A minus. There's some that are well below that. And if you're giving your money to a carrier for 3 to 5 years, maybe you're okay with somebody that's not A minus. But if you're giving your money to them for 10, 20 years, you really want to make sure they've got high ratings. And so I think people with long duration asset generation expertise and high ratings are going to do really well. And it's going to split sort of the well-capitalized haves and have-nots. And we think we're really good at those things, long duration assets, and we think we've got a strong capital base.
Great.
Can I just add something? You know, why like we feel like annuities are so important. There are really two risks when you're looking at managing your own assets, and people typically think of it as just one risk. They think in terms of running out of money, right? You may run out of money before you're dead. The other risk is that you actually spend too little money. And there have been statistics that show that people in retirement 13, 15 years after retirement some people still have 80% of their assets. And what happens is if you're retired, you should be out there enjoying your life, right? And so if you're spending too little, that's a factor where you're not really going out and doing the things that you should be doing, enjoying your retirement the way you should be enjoying it. And that's because of the uncertainty. And so an annuity takes away the uncertainty of both running out of money and also of spending too little money, because you know that you're going to have a consistent income over a long period of time.
That's a great point. Mike, you want to add?
No, and again, I think and we're not here to sell annuities, but if you're interested, we've got.
He's got a guy. If you want,
We've
one.
got a guy.
In the back.
So
He's in the
but,
back. He's got applications.
And again, I'll give you a regulator's perspective. There was a period where annuities, were viewed somewhat skeptically because there were a lot of different types of annuities out there. Some very complicated with, all kinds of features that made them very hard to regulate, and ultimately, were very problematic from just a company solvency perspective. And you saw a lot of those products go away after the financial crisis. But the types of products that we're talking about, fixed index annuities, very simple products, which are, just guaranteed income. As you've heard from a societal standpoint, we're kind of the envy of the globe in terms of even having a market for those types of products, because they mirror what people we're accustomed to in terms of pensions, just a guaranteed income for life. And I've been talking to a lot of regulators and policymakers in Europe and Asia who are looking at the U.S. market, and their systems are very reliant on public pension systems, which, to be honest, are not in really great financial health. And so, they're looking at kind of our marketplace and trying to figure out how they replicate that. And they made a lot of regulatory decisions in places like Europe that did a lot of harm to the ability of that type of product to exist, and they're, I think, regretting that now. So I think you'll see kind of a resurgence around these guaranteed income products, and especially for somebody like me who's spent his life pouring money into a 401k. That's great. But again, that's a lot of concentration of my sort of investments in highly liquid, highly volatile stocks. We've all seen what's happened with our 401k plans over the last few years. But it doesn't provide sort of, as you've heard about, this deaccumulation features. Like when you get to that part of your life where you start to want to have return from those investments, 401k is not gonna do it for you. So I think a lot of Americans are starting to figure that out, and thankfully we have an industry and a sector that is able to offer those types of financially attractive products to the market. And I think the business models that you see represented here have led a lot of companies, in what we call sort of traditional life companies, to kind of replicate that approach, which is a good thing. But again, what we also don't want to see is an acceleration of like who can sort of, if there's a drive to getting maximizing that yield, and then you start to increase the riskiness of your investments. That's where I think we all get a little bit worried.
Yeah, I guess we talked a little bit about pensions, so I'm going to ask a question around pension risk transfer since we kind of brought that up. Some of that has got some attention, both in kind of financial media, but with regulators. When you look at those large transactions, and private equity-backed firms have won some of those mandates, right? Is that additional risk, you think, for the consumer? How do carriers look at those deals when they win them? I guess kind of what's your take on those pension risk transfer deals and maybe some of the folks that have been a little critical of them?
Yeah, I can start. I think it's an area where, from both a public standpoint, from a political standpoint, from a regulatory standpoint, they have to kind of understand what's happening in a transaction like that. And with the pension risk transfer, essentially, what is happening is a
Actually, we probably should define that. Maybe pension risk transfers is you want to define it, but maybe some students may not know what we're talking about.
Yeah, I was going to do that. So, I mean, it's basically where a company, pick a large, company, takes its pension obligations. It has a traditional pension plan for its employees, and transfers that to an insurance company to replace it with an annuity product. So, in the end, the employee is still getting the benefit of a payment instead of coming from the company through a pension payout. It is done by an insurance company through an annuity product. So from, again, an employee standpoint, they're like, what's happening here? I thought I was going to get a pension from my large company. And so there's a little bit of a consumer kind of reaction to that. I think they've come to understand, though, is there's a lot of companies who, if you look, at the newspapers throughout the last decade, who ultimately are not able to carry through with their pension obligations because of their own financial challenges. So a lot of pensions in a lot of companies are underfunded, and in some cases, are basically get to the point where they're not able to pay anything, which point they get transferred to a federal entity which pays out something. So there's more security in many respects with a highly rated, highly skilled company with investment experience to take over, frankly, a role from a company that is, its expertise is not in investments and not in sort of managing long-term liabilities. So I think overall it provides a really good solution for both the company and the consumer. But again, you have to, the people who are making those decisions have to really give a lot of consideration to both the insurance company involved, into appropriate communication with the employees. These types of transactions, perfectly permissible, I think in some respects recognized as a way to decrease some of the financial obligations of the companies. They get to take those risks off their books, transfer them to somebody else, and allow them to continue to grow and otherwise give their capital in places where they may need it for purposes of growth of the company. But still, you have a lot of regulatory attention. There's some litigation around it. So I think we're still trying to figure out kind of where this is going to go. But again, as I'm talking to regulators and policymakers across the globe, they see this in the U.S. and they say, that's actually a really elegant solution to solving a lot of problems. So I think there's a great deal of interest in that as a mechanism, but we've got to work through, as I said, sort of some of those regulatory and consumer dynamics that are out there.
Josh or Sam, you got anything you want to add?
Yeah, no, look, I think those pension risk transfer transactions are very consistent with what we do for a living, right? And that's we manage assets for the long term, right? They're essentially annuities. And if you we do a lot of smaller deals. I mean, Athene does a lot of really big deals, but the small deals that we do, who is managing those pensions, who's making the decisions? It's really a bunch of employees at the company, right? And when you think about some of the auto companies, think about General Motors, they can't figure out what's going on with their ignition switches, and they're supposed to be managing money for 30 years for people. And so it's really, where is that risk best placed? Is it best placed with someone whose expertise is building cars or building airplanes or doing something else? Or is it best placed with companies that for decades have been managing long-term money and know how to match assets to liabilities. And I think that's why, as Mike alluded to, those transactions really make sense.
So 2012, 2013, it was kind of when the tip of the spear happened. And back then, if you were to go look at articles that were written back then, a lot of kind of pundits had some pretty interesting opinions around the future state that this would cause for the life insurance industry. Some folks thought we would have a systemic issue by now that would have already blown up potentially. A couple of commissioners and regulators had some pretty strong opinions. Mike recalls some of those as well behind those closed doors that we were both in back then. Other than a couple of one-off issues, I don't think anything's really happened. So what do you think was missed back then to where we are now? In other words, like looking back, so, I mean, obviously the industry's evolved and changed, but it's been a couple one-off issues. But what do you think was missed back then?
Yeah, it's a good question. I don't know if anything was missed as it was sort of less really fully understood. There was a time, when it was somewhat of an anomaly to have a private equity company to purchase an insurance company. And as you said, Nick, the initial reaction of the regulatory community is, if you were in the 80s and, read the books, Barbarians at the Gate and others, books like that, there was corporate raiders coming in, going to, take out all of the assets of the company, leave it as a skeleton, make a really bad series of aggressive investment choices, leading to financial ruin and ultimately the demise of the entire financial system. That did not happen, but that was, again, when I talked earlier about, there is this initial reaction by regulators to kind of think in terms of potential worst case scenarios. But, I think as Sam mentioned, the business model, particularly for companies, represented here is, when we started to acquire these insurance companies, they were not acquired as investments. I mean, we are a full subsidiary of Apollo. And that means they are absolutely 100% committed to us and to our consumers. And our CEO Mark Rowan, is somewhat of a visionary in this area. Saw the potential of this match, but only understood that it had to be a full commitment to a full-on retirement services insurance company. That was going to be there for its policyholders for generations to come, and that's our promise. And I think regulators, as they've seen that play out now over the course of 10, 15 years, if not more, have grown comfortable with that business model. So there are less questions about sort of the marriage between alternative asset managers and insurance companies. There are still concerns, though, as we've kind of all alluded to, is this is a very successful business model. There are others who are trying to replicate that very quickly, trying to catch up, and are potentially going to make some aggressive choices. And that may not just be private equity companies. It's any company that kind of sees the potential between asset management and insurance. And so I think that's where their focus is appropriately right now, and just making sure that they, as regulators, have visibility and understanding of the decisions that are being made, and comfort that they are prudent, rational, informed decisions. But as Sam said, I think there's an appreciation, though, that the real economy as it exists is a mix of both public and private, a lot more private than it was. So if you want to be actually fully diversified in terms of your investments in the real economy, you're going to be investing more into private credit than you were 10, 15 years ago, because that's what the economy is today. But how much and in what kinds of investments, those are all fair questions and ones that we're happy to have with regulators.
Any other thoughts?
Yeah, I would put it in terms of what they miss was what I would call alignment and expertise. And alignment, how do you align the companies from a financial perspective and from a cultural perspective? We like the way that we're aligned, which is the same way Athena and Apollo are aligned, we're 100% owned on balance sheet subsidiaries. There are different ways to align the interests of companies. We like our model. We like the cultural alignment that we have with KKR. They're a company that has managed long-term liabilities, long-term assets since their inception. They've always had pensions as investors in the company. And then, the expertise that they bring to our industry is something that, from my perspective, is kind of invaluable. We went from before we did the KKR partnership, the KKR transaction, we had about 50 investment professionals. After that transaction, we had 500 investment professionals all over the globe. So, think about the tremendous power that brings to that partnership.
Yeah, I think that's all really well said. I think the thing that the guys are kind of underscoring is, when people think private equity, it's just one term, but there's various ways to own insurance businesses. So on one end, a private equity firm can put an insurance company in a fund, and so that's all third-party investors owning the equity of that insurance company. And then there's a spectrum, right? So it could be your own money of the actual balance sheet from Brookfield or Apollo, et cetera, with some maybe third party in your sidecars or some third party capital. And then there's the other end where you're just totally on balance sheet without any third party money. And that's important because if you put bad investments in that insurance business or don't appropriately operate it, the first loss is your own money. It's your own equity that's getting hurt. And so for us at Brookfield, we put about $10 billion into the business, and it's all balance sheet money without any third party. So incentives, as Sam mentioned, is critically important.
That's a great point. Excuse me, my last question before our audience potential questions. We talked a little bit about offshore reinsurance. We mentioned Bermuda. Again, gathered a lot of attention in the last few years. Do you think these transactions have embedded more risk into the life and annuity business? First kind of question. And then I'll put you on the spot, Michael, but as a former regulator, should regulators be looking at jurisdictions more individually, I guess, too? I don't want to pick on any other jurisdictions, but Bermuda come to mind. So, in other words, should regulators be looking at these per jurisdiction? So, who wants to start?
Yeah, maybe I'll. I know he did pick on me. That duly.
Well, he was my mentor.
This is all payback for decades.
We could talk about it. Yeah.
Let me answer the latter one first, and maybe defer the first question to the other panelists. Should regulators be looking at individual jurisdictions in terms of regulatory risk associated with reinsurance placed there? Absolutely. I mean, we historically have, as a regulatory community, done that. In fact, there are systems in both the U.S. and Europe to basically evaluate jurisdictions for reciprocal treatment. And in the U.S., it's called, you get the status of a reciprocal jurisdiction, which means you've gone through a process with the NAIC and state insurance regulators where they evaluate your jurisdiction, how you regulate, your level of transparency, capital and surplus requirements, and assuming you get through that and there's a level of confidence with that jurisdiction's regulatory system, you will be granted reciprocal jurisdiction status, which gives you some benefits if you have reinsurance there in terms of collateral requirements and also just not duplication of regulation. So very important. Europe has a similar approach, and there are jurisdictions that have that reciprocity. So Bermuda is one of them, and Bermuda continues to improve its regulatory sort of regime because I think they see the business that is there. They know the level of attention their market is getting. And as a result, we've actually seen, and this publicly reported, companies leaving Bermuda and going elsewhere because they want to go. Some companies, are looking for regulatory advantages associated with jurisdictions that aren't as stringent in terms of their capital and surplus requirements or their level of oversight and transparency. And again, as mentioned, that's regulatory arbitrage. It's something that we are all concerned about. And it is, I think it's a little bit of kind of regulatory whack-a-mole because your jurisdictions, will start to lock down and then another jurisdiction will pop up that, companies will go to. So I know it's something that regulators continue to look at. How they deal with it, I think there are some options that they can, evaluate. They have reciprocal jurisdiction status, which they can further elevate. In Europe, there are additional capital charges if you place reinsurance in a non-EU recognized jurisdiction. So that's another potential approach. But it is, as I said, that's at the heart of something that concerns regulators and concerns all of us, which is if you have companies that are playing games by going to jurisdictions where they can get a competitive advantage, which allows them to take increased risk, that also increases the chance that there's going to be real solvency issues, which ultimately sure will impact them, but also impact all of us.
Yeah, I would say that first of all, reinsurance transactions are actually risk reducing, and they're very beneficial because what happens is a lot of the companies that engage in reinsurance transactions have these legacy blocks. They've got a lot of trapped capital against those blocks. They've got to manage those blocks. They may not be able to manage them effectively. When they engage in a reinsurance transaction, it essentially lets them unlock a lot of capital that they can then either redeploy into more profitable businesses or into businesses that are more relevant, or they can return that capital to their investors. And if you look at what's happening in the public markets, it's very difficult for public insurance companies to raise capital because a lot of them are trading below book value. So the only way they're going to be able to get capital a lot of times is through reinsurance transactions. And then a lot of these legacy blocks, when they transfer them to people like us, people like Athene, others, we then take on the investment risk, and we're better able to manage that risk. And so what it's really doing is it's taking a liability risk and an investment risk and transferring it to people that are better able to manage that risk. And that's why I say that those transactions are actually risk reducing, because they're transferring risk to people that are better able to manage that. And they're also beneficial because they allow these companies to release and redeploy capital.
All right. Do we have time for any questions? All right. I think we're up on time. So let's give this panel a round of applause.